Welcome back. This is not financial advice. I'll ask you to like the video and subscribe to the channel if you haven't already, and we will get right into it. So, today's video is one that I wish I could have recorded and then sent back in time to my earlier self 2.5 years ago before I bought my first stock. And so, if you are a new investor or someone who just has this unnerving feeling that their investment strategy isn't quite right, this is the video for you. So, what I've come to realize over the last couple of years is that a strategy as follows, what I've described as the three portfolio strategy: core, satellite, and moon. This is a strategy that I've developed or devised just doing a lot of thinking and reflecting back on things I've done right, things I've done wrong, mistakes that I made, and what I would do differently if I could start out again. So, this is something I'm really excited to share with you, and I'd love to get your feedback and see what thoughts you might have in the comments below. Um, so, to start right into it, I think that having a core position, um, having a core position where we dollar cost average no matter what. So this is a portfolio that would, reading right off this handy dandy document here, it'd be a broad market fund or funds, something that we dollar cost average into once a week, twice a month, once a month, rain or shine, independent of what the market is doing. We buy. We buy our stocks like groceries, not like perfume, as Ben Graham said in the past. And so for this portfolio, which I think should be about 50% of a taxable position, if I was giving advice to myself, it would be constructed again with market cap weighted funds, funds that are passively managed. So that means they're not actively managed. That means that they're going to have low expense ratios. But what it also means is that, for instance, in the case of, say, the S&P 500, um, it simply is tracking the performance of the top 500 stocks in the US by market capitalization. There's no human emotion involved. And so there's no stock picking involved. You don't have to track what's doing well and what's not doing well. You dollar cost average into it. Every time that you have money to invest, you park it here. So this allows you to eliminate market timing, remain fully invested no matter what's going on, and it's insurance against single stock risk. So we're going to take a look at three quick examples of that. I will remind you to subscribe to my channel if you haven't already and like the video as we get started. So the first option that we would have for a core portfolio could consist 100% with Vanguard's VT ETF. And so Vanguard VT is Vanguard's total world index um, ETF. And so it is every company in the world. I believe there's about 10,000 companies that are within VT, Vanguard VT, and they're all weighted by market cap or by how popular each company is in simpler terms. So it's about 60% US stocks, 40% international stocks. And within, that top 20 list, you're going to see stocks such as Apple, Microsoft, Google, Berkshire Hathaway, but you would also see stocks like Alibaba. You would see some international stocks in there. Within that top 20 or 25, you'd see other stocks such as the Royal Bank of Canada and things of that nature. So it's, mostly American, but then interspersed with the international stocks from most popular to least popular. So over the last year, the fund here, VT, Vanguard's ETF, has returned 9.5%. 5-6%, which is certainly respectable. And again, this is just so if we make a mistake in our individual investments, no matter what, around 50% of our money is going into something with a decades long track record of compounding. See, the risk that we run into is if we suffer unrealized losses for several years in a row, we're not giving our money a chance to compound, and that's certainly what we need to be doing. So, moving right along, we're going to take a look at my second option that I have here. This would be a core portfolio. Core number two would just be 100% VOO. So that's the top 500 companies in the United States, market cap weighted, as described earlier. This fund has returned 12.91% um, in the last 365 days. Um, Warren Buffett's favorite investment. Simple enough. Moving right along here, I'm still here. I hope you are as well. And if you are, hit like and subscribe. I appreciate it. This would be a fund. Core number three. This might be a little bit of a Jack Bogle themed fund. It might be something that you choose if you're wanting international exposure, but wanting to be a little bit more exposed to the US. And you could tweak these percentages. Probably no less than 20% international. Um, and no more than 40% international, which is that VXUS. But this is a seems to be a pretty popular allocation for some folks, and this one split the difference on the return. So it's returned 10.65% over the last 365 days. And VTI, what that is that's the top 500 stocks in the United States that makes up 80% of VTI. Okay, and then the other 2,500 stocks, which are mid and small cap stocks, that makes up the other 20% of VTI. And then again, VXUS is the entire rest of the world minus the United States, market cap weighted. So that's going to be a lot of stocks that are in um, China, Canada, um, the UK, Germany, France, and down on throughout the list. So this is where we dollar cost average in. Anytime we have money, no matter what the market's doing, we just pile money into this. And along with the name of the YouTube channel, Not Financial Advice, if you're a younger person, this could be looked at as the new savings account. Give your chance, give your chance of money, give your money a chance to grow, rather. So, we're gonna come over here, and now we're gonna explore something that's a little bit more interesting. I'll ask you to like the video, subscribe to the channel if you haven't already. But this is the exciting part, or one of the more exciting parts. Probably one of the probably the place where we have the biggest chance of outperformance. And so, if I was talking to myself 2.5 years ago, I'd say, anywhere between 40 to 50%, give or take, can be individual stocks or ETF sector style ETFs that we can include in a satellite portfolio. And so here we're picking stocks. Um, Also, we can include sector based ETFs as well. Say we want exposure to banks. But we don't understand the banking industry, you can buy a banking ETF and sort of make it part of this satellite portfolio. So there's a possibility of outperformance here, also a possibility of underperformance. Unlikely a possibility of total capital loss. But to get started in a portfolio such as this, you could lump sum to start, and then you could dollar cost average in. Um, but the way that I would look at it now, and this would be something I would add, don't be married to the idea that portfolios have to be neat and orderly. You can open up a portfolio like this with an equal allocation, um, and dollar cost average in, let the winners win. Or if a super solid company has a single bad quarter or a minor scandal and the market responds irrationally, you can jump in and double down on that position, which will make your fund um, not symmetric, but that's okay. Any fixation, and this is a fixation that I had in the past, is that things should be equal and symmetrical. Pff, no, just no. So water spray bottled to my own face 2.5 years ago. Um, in a portfolio like this, you would let winners win. Rebalancing shouldn't happen here. I would note that in the last core portfolio we looked at, 75%, VTI 25%, VXUS. If that's the allocation that you're comfortable with, you would want to rebalance that on a quarterly basis, being aware of any tax implications of that. But in a portfolio, the satellite portfolio, maybe it's 40% of where your invested dollars go. We're only selecting high quality companies. So companies, hopefully, that all have wide moats, growing top line revenue, growing free cash flow, low debt, high returns on capital employed or invested capital, and good management. And so I'm going to bring us over here portfolio where we can sort of get an idea of what a properly constructed satellite portfolio um, could look like. And so these are absolutely not the specific stocks that I would have purchased, but there are certainly some in here that I would have selected. Some in here that are definitely worth a close look by anyone considering a different strategy. So in this satellite portfolio, what we've actually done here is we've started with 25 equities, equal weighted at 4%. This would be a good time to talk about, extreme concentration. And so acolytes of Warren Buffett, keep in mind he has 60 positions, but people who are super big Warren Buffett fans, they're really proud of their 8 and 12 um, 8 and 12 stock ETFs. And I'm not saying that that's risky if they're the right investments, but there's going to be a lot of volatility there, and it's something that should be reserved for, I would say, an extremely advanced investor. As far as an individual investor goes, I tried it. I didn't have the stomach for it. For instance, I bought $4,000 or $5,000 at Amazon and watched it go down 50%. Um, I bought a bit more, but I really, thinking I was the next Warren Buffett, I just thought I could buy $5,000 of a stock at all time highs, which you wouldn't have done. Um, but I looked at it, it looked like it was fairly or undervalued. And there were things that I couldn't foresee. I couldn't foresee um, that inflation and rising interest rates and the pull forward of demand for um, consumer items being delivered through Amazon would force Amazon to double their fulfillment capacity in 18 months, which messed up their free cash flow and their earnings per share and contributed to the decline of the stock to the tune of about 40 or 50%. And so, while I had the courage and the conviction to hold and to not sell down, it was very hard to buy more of that stock as a new investor. And I ended up um, engaging in probably some excessive diversification, the what if I'm wrong, and also just feeling burned by that stock. A little bit of a tangent, but it's really a good story to share because this is part of why I'm sharing this um, academic portfolio construction strategy with you. Is because this is what I wish I would have done, and I would have had better performance. And at this time, I'm trying to incorporate some of my own advice, not just do as I think, but do as I say and do, right? So, whatever. Satellite portfolio. So, 4%, 25 stocks, equal weighted at 4%, returns of 17.56%. This is just an example. We can see here that it has a low expense ratio because it's a lot of individual stocks. Pretty generic dividend yield of 5, 8%. But this would be an example of the types of companies that one might consider for something like this. So Google, Amazon, Apple, Berkshire, Coca-Cola, Costco, Johnson and Johnson, Meta, Microsoft, Netflix, Pepsi, Procter and Gamble, Salesforce, Charles Schwab International Dividend Equity ETF, SCHD, Aerospace and Defense Sector ETF, Starbucks, Home Depot, TJ Maxx, United Healthcare, Vanguard Healthcare Sector ETF, Vanguard Small Cap Value ETF, Vanguard Total International Stock Market ETF. Maybe especially if your core holding is just the just VOO, might mix in some international either funds or stocks here. Vanguard Utility Sector ETF and Visa. All right, so this isn't exactly what I would be looking at, but it's pretty close. And I might open up. I would have been benefited to have put $6,000 into this portfolio as a lump sum, even at the height of the market, and then allow the different positions to grow or shrink, and then reassess where I'm at. And well, for instance, Berkshire or Costco didn't have the drawdowns that Amazon did. As I saw these steadier rising in 21 and 22, I would have been a lot more psychologically apt to reinvest into Amazon. So this is an example of why this portfolio strategy could be really good. And you know, um, Peter Lynch had 1,000 stocks at Fidelity with help, of course. Ray Dalio has 750 stocks with help, of course. Buffett has 60 stocks, but he has a lot of concentration within his top 10, right? And so there's 500 stocks on the S&P. I think 25 individuals, equities, um, that you're buying, opportunistically. I don't think that's too much. I don't think it's uh, too few. I think it's a really good number, and you could look at 25 or you could look at 20. Um, but I really feel that that's a pretty good range to be in, and I hope that makes sense to you. Um, if it does or it did, go ahead and like the video, subscribe to the channel, and we're going to get to our third and final part of this presentation, which would be the Moon portfolio. So this is gambling. What it does is it scratches that itch, um, to invest in companies that you just want to invest in. And we'll talk about why you might want to allocate anywhere from 0, 1, 2, 3, 5, 10% of your portfolio into something like this. But these are going to be companies we're looking at, um, possibly for some short-term trading. Um, Not too much, but in the case of like a turnaround, or even an arbitrage play, which I don't have time to explain, but um, maybe mm, arbitrage. Yeah, I don't have time to explain it. I love you, but I don't. Like the video and subscribe to the channel. So, this would be a good place though to have certain stocks, um, that you are hoping would be a 10x, a 10 bagger stock, things of that nature. So here we're picking stocks. We may pick ETFs as well, and there's the possibility of significant outperformance, or when we're talking about really risky stocks like this, the real possibility of total capital loss, of parts or the entirety of this portfolio. So you could lump sum to start, and then you could DC into this, maybe 25 bucks a paycheck. Um, in this Moon portfolio, this is money that we should be absolutely 100% writing off as if we were going to the casino. Um, we're hoping that we can get some really strong outperformance on it, but don't quit your day job. Don't quit your day job. So we could DCA 25 bucks into this, or we could do some opportunistic buying based on developments of the companies, etc. So you could do some trading, either be it arbitrage or turnarounds, but these are moonshot companies. So companies that are either pre-profit, companies that are high conviction for you, deep value traps or deep value stocks, turnaround plays, and generally different stocks that might be a bit speculative. And so I'll give you an example of what something like that could look like. So here, I just drafted a model portfolio. It's just sort of a smattering of different things that would reflect, an allocation of 0 to 10%, if at all. But in this particular case, hindsight's 2020, but I could have seen myself investing in some of these 2.5 years ago, $25 at a pop. And in this particular case, this portfolio is up 39.09% this year. And so, you could start off with equal weighting and, either let it run or DCA, however you want to play it. Um, 10 equal weight holdings at 10%. So we threw in a cannabis ETF. Regulation makes it hard for this company to have profit. British American Tobacco might not be a company in 20 years, but it sure is paying a safe 9% dividend right now. So risk, right? Not typically what people think of a moonshot, but probably something that's not appropriate for a 20, 30, 40-year portfolio, right? So Chewy. A I think this could be the Amazon of pet food. Although Amazon sells a lot of pet food, this company just posted their first 4 quarters of positive free cash flow growth. Um, there's some bad things with their financials. I might do a video on it at some time, but companies like that, companies like Coinbase, when people are mining for gold, sell shovels, something that's really correlated and even posting stronger returns than Bitcoin, but something that's correlated to Bitcoin or crypto. Foot Locker, a turnaround play, doing really well recently, down a huge, huge amount from all-time highs, really has bounced back. Same thing with Intel. Lululemon, maybe you love their products, their clothing. They're going to be added to the S&P 500, I hear. So to have a little bit of exposure to a company such as this, um, wouldn't be the end of the world as long as it was 5% of your holdings, right? Contributing to 5% of your holdings. So like Nvidia, ridiculous valuation, most likely. Check back in 10 years. Tesla, a company that's um, of decent quality, but it doesn't hit the qualities laid out on a high conviction holding for a long-term portfolio. The satellite portfolio, those 5 or 6 different criteria I laid out, it doesn't it's not the highest of quality stocks. But there's a lot of growth potential there. So you don't know. Uber, um, turnaround, high growth, nascent profit. Definitely something that you could see being a lot bigger of a thing in 50 years. Maybe we get robot taxis in 50 years. And so, that rounds out the concept here of the 3 portfolio strategy: core, satellite, and moon. If you enjoyed the presentation, like the video, subscribe to the channel. If you have any thoughts or questions about anything that we discussed here, again, drop them in the comments below. Like the video, subscribe on your way out, and I'll see you on the next one.